FHA, real simple. Required down payment is 3.5% down. So 3.5 equals down payment, DP. Cool. FHA has two types of insurances. They have what is called the Upfront MIP, Upfront Mortgage Insurance Premium. And what does the Upfront MIP equal in terms of a percentage of the loan amount? 1.75%. Yep, 1.75%. Here's a trivia question. I do not know this answer. My brain does not retain the information that it used to in my younger years. Is it less if I do a 15-year fixed mortgage? My Upfront MIP?
No, it's more upfront.
Yeah, is my Upfront MIP cheaper if I do a 15-year fixed mortgage? I don't know this answer, legit. Like, please don't, I'm not trying to trick you guys. I'm gonna get out my pocket computer right here. Here's something from www.hud.gov.
Sounds official.
Yeah. Now, remember, I need to check what on this? The publication date. Yeah, what's the date on this? This looks pretty accurate. Ask me how many FHA loans I've done in my career. Dio, how many FHA loans have you done in your career? Too many to count, like hundreds. Ask me how many FHA 15-year fixed mortgages I've done.
Yeah, here it is in 4,000.1.
Zero.
All terms.
4,000.1. If you are doing an FHA loan, this right here, that's your Bible. That's it. New Testament, Old Testament, it's all there. Okay? That is where you find the guidelines. Just Google 4,000.1 to give you the answer. But the Upfront MIP is 1.75%. Okay? All right. You also have MMI. MMI technically stands for Mutual Mortgage Insurance. Monthly mortgage insurance. You see, the federal government regulates HUD, right? It's a government entity. FHA loans come out of HUD. And there are stipulations that says, hey, HUD, you must have X amount of dollars in loan loss reserve, right? Like if another 2008, 9, and 10 happen, we got to have an oh shit fund. Currently, whatever that government mandate is, we have like 3 times that amount of money. So something going on in our industry right now is people are saying, guys, this is too much. Guys, this is too much. We don't know what this number is yet, but it's too much. Let's reduce it. It's a big push, especially coming out of the new administration. But HUD's saying, hold your horses. We still have like 5 million people in forbearance. We could experience loan losses greater than we saw in 2008 or 9. We don't know yet because people have gone a year. They haven't had to make their mortgage payments. Let's see how this thing unwinds over the next 12 months. And as we get towards the next 12 months, we could see this go down. We could see this go down. In my career in the past 16 plus years, this and this has changed so many times that's why I can't remember. Because when I got started, I think it was like 1% up front and 0.55% monthly. This monthly MI, by the way, 0.85%. What's that?
55 for refis. Streamline.
Your upfront is.
No, yeah, but Streamline is
The-
55 bips.
Okay, cool. So this Upfront MIP, Jimmy just looked up in the 4,000.1. He just looked up that on a Streamline FHA refi, your Upfront MIP isn't 1.75%, it's 0.55%. Just good to know, right? A Streamline refi is when I'm taking someone who's currently in an FHA loan and I'm throwing them into another FHA loan. I get to do so typically with no appraisal, no income requirement, no asset requirement. I just have to prove that they have not missed a payment in the past 12 months. As long as your mortgage payment has been on time for the past 12 months, we will lower your rate, or lower your term, but lower your rate, or lower your rate and lower your payment. Which, if it makes kind of common sense, why wouldn't you? If someone's already making their payment on time, you're only going to better their situation by doing a Streamline refi. But those people still have an Upfront MIP to pay. Something cool to know about the Upfront MIP. It is refundable. prorated for your first 3 years. Again, this is a good to know. I really don't know how it would really transpire, except let's say I'm doing a loan for someone and FHA is really the best way to go today. But I'm looking at their situation, I'm like, gosh, over the next 18 months, you could really better your situation and we could refinance you into a conventional loan. Maybe they're only, I don't know, 2 years removed from bankruptcy, and in 2 years, they'll be 4 years removed from bankruptcy. Maybe they're gonna be able to pay down some debt. Maybe they're gonna be able to get further away from a collection they had, wherever the case may be. As a lender for life and an advocate for my consumer, maybe I'd wanna know, hey, by the way, I know that we're gonna be charging you this 1.75% up front, but if you refi with me in the first 3 years, you're gonna get some of that refunded back to you. Just a good to know that your UFMIP is refundable within your first 3 years. God, I'm looking at Jimmy right now who has his computer in front of me. I pray to God that's still correct. I pray to God that is still accurate. It shows up on the payoff, by the way. Your payoff would be reduced. So this is something that don't dig too deep into it, and this could have very well changed and Dio's just not in the know. So cross-check me on that one. All right, so let's do this. Let's do an example. Our example is going to be a $250,000 purchase price. By the way, another sidebar, this 85 basis points, right, 0.85%, this 85 basis points in monthly mortgage insurance or mutual mortgage insurance. Yeah, so you go down to 80 once you put down 10% or more on a 30-year loan. Yeah, whenever your mortgage term is less than or equal to 15 years, some of this stuff changes, right? So just know that. Know that we're gonna calculate this based on a 30-year loan, and we're gonna talk about a 30-year loan. But if you ever, for whatever strange reason, you had an FHA borrower who wanted to do a 15-year fixed, just know that some of this is gonna change based on it being a 15-year term and not a 30-year term. But also know that's very rare that you'd ever do a 15-year term on an FHA borrower. But yeah, if you put down 10%, just like it's very rare that you'd ever put down 10% on an FHA borrower. The way that you would put down 10% on an FHA borrower would be because we've learned FHA has maximum loan amounts, right? We taught a class on that the maximum loan amount here in Central Florida is, yeah, it's low to mid 300s. Maybe you had someone who wanted to buy a $375,000 property and their credit profile was one in which FHA was either the only choice or it truly was the best choice and they had assets. I could see you putting money down, but most times when you're doing an FHA loan, you're not putting down more than 3.5% or 5%. But if you did put down 10%, the mortgage insurance gets a little bit cheaper. All right, so anyhow, we're gonna go ahead and calculate a payment real quick so we can get on to maybe talking about PMI. So it's a $250,000 purchase price. So 250 equals purchase price. What did you say, Cam? 8,750 equals my down payment. All right. So then this means that I'm going to have a loan amount of how much? 241 what? 250. Guess what we call this on an FHA loan? We call this a base loan amount. All right. That's your base loan amount. This is not what the person's payments can be factored off of. Okay, we have this thing called an UFMIP. I have to factor in how much is my UFMIP going to cost me? Well, it's going to cost me 1.75%, 175 basis points of my base loan amount. So I'd have to get out my handy dandy calculator. I'd have to say 241,250 times 1.75%, 4221 is my UFMIP in terms of a dollar amount. Now, I'm gonna have a loan amount of $245,000. You ever find it's hard to write at the very bottom of a page? Same thing on a whiteboard. All right, this is gonna be very important. When that's a 2, by the way. When I calculate my borrower's payment, I'm not calculating the principal and interest on the base loan amount. I'm calculating on the total loan amount. Okay, so now, let's just assume my rate's 3.5%. Now, if I got out whatever amortization calculator that you use, I use an HP 12C. It comes highly recommended by anyone in the mortgage industry. Not anyone actually, because I know you guys these days use something different. But I'm gonna say 245,471 is my present value. 3.5 is gonna be my interest rate over a 30-year term. Then my payment, I'm coming up is $1,102. Anyone else coming up with something different? 1102, is that right? I'm asking because sometimes I have like the wrong keys punched into this and, okay. So, just kind of make this box over here. So my PI equals 1,102.27. Cool? Following along? All right, so this is FHA loan. We know we have monthly mortgage insurance. We know the monthly mortgage insurance is 85 basis points or 0.85%. Now that's the annual cost of it. So we're going to have to solve for what is it monthly. Here's the trick. Am I going to calculate this based on the base loan amount, or am I going to calculate it off of the total? Nope, the base. So think about this, how I remembered it back in the day. I don't like to be double taxed. I'll pay taxes once but not twice. So please do not tax me up front. By the way, thank you for letting me roll it into my loan, because there's no way in hell I was going to have the 3.5% to put down, plus another 3.5% for closing costs, plus this $4,200. So thank you, HUD. I got to roll it into my loan. But yeah, please don't charge me 0.85% on this big dollar amount when part of this is another mortgage insurance. So we're only going to calculate it off of the base. So when I'm calculating that payment, I'm going to come out with $241,250. I'm going to times that by 0.85%, and it's going to give me a number. What's that number? Yeah, so should I put that $2,050 right here for the monthly mortgage insurance? No, I should do something with it, right? Divide it by 12, right? Because that's the annual amount. The annual amount is $2,050 and change. Those with calculators that work and aren't dropped on the floor, what's my MI? 137? 170? Come on, federal government. All right, 170. Do you think you would do more of these out of curiosity if that number was $110? Yeah. By the way, currently, this is forever. Forever. Yeah, this is forever. It wasn't always forever. Yeah, but let me ask you this question. Does it really matter? Think of your typical FHA borrower. Does it really matter that this is forever? I mean, perception, it does matter. I'll tell you as someone who helps run a mortgage company, yeah. Like all of a sudden people are like, no FHA loans. That MI is forever. And it's like, let's walk through the psychology of your typical FHA borrower. Usually first-time home buyer, going to own the home for what? 3, 5, 7 years max. So are we really talking about forever, or are we talking about the next 3, 5 to 7 years? Okay, let's talk about the next profile of an FHA borrower. Maybe they had an adverse credit situation that they're still recovering from. So maybe FHA was the best bet, but because you were their advisor, you put them on a path of financial freedom. So in 18 months or 24 months, you're going to refi them anyhow because they're going to be in a much better situation. At which point, was this really forever? No, it was for now. It's for the temporary. It was a patch, a Band-Aid, right? But for whatever reason, when that became forever, because it wasn't always that way, it became a huge hurdle, obstacle to overcome. So the goal with the new administration, assuming they don't suffer a bunch of loan losses over the next 12 months, maybe we can reduce this number, right? Maybe it's not 0.85, maybe it's 0.6, and maybe it's not forever. All right, cool. So calculating a payment, I now have tax, I now have insurance on a $250,000 property. Taxes, what's a good rule of thumb? I like to go with 1.25% of the purchase price. Let's see if that would work. What's my purchase price? $250, 1.25%. Yeah, somewhere in that ballpark. Somewhere in that ballpark, right? 260, let's call it 275 a month. Ideally, if your borrower had a property in mind, you could hop on the county's website, right? You could pull up the property address. You could take a look at what the taxes were last year. You may even be able to do what's called a tax estimator, where you put in the purchase price, whether or not it's going to be homesteaded, and it'll spit out a number. Insurance, by the way, we live in the state of Florida. Insurance is through the roof. I would tell you on a $250,000 home, at a minimum, depending on the age of the home, et cetera, you're $150 a month. Yeah, I mean,
Doing 175.
cool, yeah, do 175.
It's better to go higher, I think.
I like that. Best saying it's better to go higher in your estimates. Yeah, have you ever had a borrower get totally angry at you when they got to closing and their payment was less than what you told them it was going to be? They got mad at you when their payment was less?
No.
Yeah.
The opposite.
Yeah. No one's going to get mad at you because they brought less money to closing than you estimated and their payment came in less. But like, don't go crazy. Like, we should still be accurate on our estimates. Just be on the safe side of accurate. All right. So anyhow, you total all this up, and with a calculator, what do I have? 1102, 3. What do I have?
1512.
All right, there you go. That is calculating an FHA payment.
No.
Oh, come on, Jimmy.
Gotta add the MI.
Gosh darn it.
Well, people got that wrong.
Well, I was using.
He was too busy looking up stuff in the 4000.1.
No, what of that? 17, 22, 27.
What is that, Jonathan?
1,722, 27.
Dude, I need to have you on the podcast with that voice, right? Crush it. Absolutely crush it. Yeah. There you go.